Hello, it's Brian Shannon from AlphaTrends.net. Today's Friday, the 17th of October, 2008, and we finished another week off here. Actually, this week was up, believe it or not, 5.4% on the S&P 500. It seems hard to believe, but we did finish today with a loss of 48 cents, or about a half of a percent. There's been a lot of calls for the bottom in here recently, and I want to just remind you that we remain in a primary downtrend, and picking a bottom is the hardest job there is on Wall Street. There's a lot of good tradable rallies within a primary downtrend, but to think that this is what a bottom looks like is not correct. Bottoms take time to evolve, and there's just not that evidence in here. Yesterday we saw a little bit of encouraging sign with that larger volume and the failure to create a lower low in here. But again, when you back it up to the weekly time frame, it's easy to look at and say it's deeply oversold and in need of a bounce, but we're not getting that bounce. So there's still sellers out there, and today we saw them push the market down a half a percent on a day when the world's smartest investor said that he's buying stocks. So just because somebody else thinks it's a bottom or is buying doesn't mean that you should rush in there. There's still good tradable rallies, and since yesterday when the market started moved above that 2-day VWAP at this point and held the 1-day, it made a good tradable rally, and it's still a tradable rally, but we're back below that 5-day moving average on a closing basis for the week, and the risks remain skewed to the downside. We've got this little trend line here from the October 3rd high we can look at that maybe breaking past that level will lead to a rally, but when the primary trend is lower, it's guilty till proven innocent, and the path of least resistance is lower, meaning that you've got to be very suspicious in here, and the failure for a real bounce to materialize in here is reason for real concern. I had posted on the blog earlier today, basically the comparison of the Dow Jones Industrial Average right now compared to 1929, and I brought that up again, but in a different perspective, that in 1929 the market looked very similar to what it does here, but then including through today's close, but then the following 4 days it dove another 8% below the low, which in this case, well, for the Dow Jones is what we're looking at, and I'll pull that up right now, would indicate a price objective of I believe it was 72.50. So it was basically 8% below the low. So we're not out of the woods yet. We can trade the rallies when they present themselves, but I still think it's a day trader's environment. If you're going to hold stocks for more than a day or two, make sure you're doing it with very small share size, and also be aware that we are still in the middle, or we're just beginning basically earnings season. I think breaking back below maybe this level would pave the way for a test of this level, and then if we get, if that gives way, then it's likely that we will see not just a test of these lows, but another fearful wave of panic selling basically. The Russell 2000 was down $1.42 or 2.6% today. It doesn't, just because there's a green candle doesn't mean it was good. It just means that it opened lower than where it closed in here today. But on the daily time frame, as far as today goes, it was a good uptrend for most of the day, but later in the day the sellers did reestablish with these lower highs and lower lows, and then finally they broken back below the daily VWAP and were able to push the market lower right into the close, and that's true also for the SPY, that it was a favorable session for most of the day. It was in the last hour, last half hour really, that the sellers came in and finished their business. Now today was options expiration day. A lot of times the market goes the opposite direction of the expiration pressure, so maybe we see a little bit of upside, but still got to be super careful in here. Gold continues lower. It was down $2.08 as far as the GLD goes. It's got a declining 50-day moving average. It's guilty till proven innocent. Longer term on the weekly time frame, we've got lower highs. We don't have a lower low yet, but it's looking like just a break below that level will continue there. And stocks and the market doesn't always trade on logic. Let's take a look at oil, because oil was down another 19 cents in here today. It did recover from a deeper sell-off, but still thinking that basically 55 to 60 $60 is where this market is likely to find some support, and bottoms aren't typically V-shaped. They're more like this. They come down, they get oversold, they bounce a little bit, another leg lower, and then it takes time. You need that 10, 20, 30, 40 week moving average to flatten out. Then you need to see a pattern of higher highs and higher lows. This is where really we had confirmation of the uptrend in oil from a long-term investor standpoint. This is where it began. This is where we had confirmation with this higher high, and you want to stay long with the higher lows just for future reference on any other bull markets that you may think are evolving. They don't evolve from conditions that look like this. They correct through price, they correct through time. The financials were down 43 cents today. They're having trouble with this area that we have identified as prior support and the potential to continue to act as resistance. That's in that $17 to $18 area. Today they were down 43 cents. For the week they were up $1, 1.79%, but still in a downtrend, guilty till proven innocent. You can look at these bounces. You can look at what the government's doing, buying pieces of them, but who are they buying them from? They're buying them from funds that still may be liquidating. We'll never know until well after the fact whether these hedge funds are still selling, whether they're trying to lie to the public so they can get better prices or for their sales, or what they're doing. But the financials remain in a downtrend. It's a very difficult environment for long traders to make profits in, and support broken tends to act as resistance. That's what we're seeing in here. If this market had real buyers behind it, it would have recovered quicker, and that goes for all of these markets. So it still remains a very volatile environment, best suited for the most aggressive day traders. And as far as investors go, really you're probably better off with cash under your mattress. But let's take a look at the NASDAQ 100. The NASDAQ is again also another market that's deeply oversold here. We got back to these lows here, at least on a closing basis for the week. And if we put the Fibonacci back on there, you can see that as far as this longer term bull market, that this bull rally in here, that we are still below that 2/3 retracement. So people consider that to be basically broken, and that a true reversal. Here on the daily time frame, we had a green candle in here as well. It finished up 4 cents. Nothing to get excited about from a bullish standpoint. Yesterday we saw the lower low, that is on Thursday, and then some big volume that gave us reason to think that maybe it can materialize into something more. But we've really, even from the beginning of the week, if we take a Fibonacci off that high to the week's lows, where did we come up? Well, we retraced exactly 61.8% of this high to that low before we found sellers in here today, and those sellers pushed the market back below that 5-day moving average. And you can see they came in this market as well right at the end of the day. Study some of those historic charts on the blog. Just type in historical and it'll pull up, but it's not clear that we're out of the woods yet, so just continue to be very careful. We're in a very dangerous environment.